We'll get going here since we're a couple of minutes behind. Sorry to keep you guys in the lurch. For those of you that don't know me, my name's Jack Kiley. I am one of the principals here at MidAtlantic. We are a provider of self-directed retirement accounts. What that allows people to do is to invest in a myriad of investments other than just stocks and bonds. Tonight we're going to be talking about lending, loans particularly, and we're gonna touch on three types of loans. One is hard money, the other is what I refer to as private lending, and then we're going to talk a little bit about buying an existing loan. So that's the brief outline. Personally, I do a fair amount of lending. I used to be more involved in real estate than I am now. Most of my portfolio is loans. And quite frankly, for me, I find it's a much easier investment to manage. You'll hear that term every once in a while. There's a little blip out there. Lending is tenants without toilets. And I find that to be very true. When I had rental property, whenever there was an issue, it was usually, I could tell you when there was going to be an issue at one of my rental properties. It was either when I was out of town, it was really crappy weather outside, or I wasn't feeling well. That's when the issues arose and the phone calls come, and then you have to manage all of that. And with lending, that's not really an issue so much. I'm just going to go over quickly in the beginning here some of the elements of a loan or things that I look at. And again, this is me. I'll tell you when this is my personal opinion and what have you. You can take these to be guidelines. So when you're thinking about lending money, really, I find that a lot of people, it's almost as if they want to do somebody a favor. And if you're thinking of it in that way, it's probably not the best place to start. You want to really look at it from your perspective. What are the things that you're looking for? For instance, my time horizon on investments is usually maybe 5 years at the longest. So I don't really want to make a loan that's longer than 5 years. So if somebody is looking for 10 years or longer, I might consider amortizing the loan on a time frame longer than that, but my term is 5 years. Other people have other gates, but the point to this is think of it from the standpoint of what's in your best interest, not necessarily the debtor's best interest. And I find when I talk to a lot of people who want to make loans, they almost, again, they're looking at it from the perspective of the debtor, as if they're doing the debtor a favor, as opposed to really what's in their best interest. So be selfish, really, because it's your money, right? And you need to protect it. IRAs are a good avenue for holding loans. Here at MidAtlantic, lending activities are probably the second biggest asset class for our clients, right behind real estate. And they tend to run pretty close to each other within a couple of percentage points. Quite frankly, they go hand in hand. We have a lot of people who used to be heavy in real estate that are lenders, a lot of lenders who hold real estate as well. So again, it's a good asset to hold in a self-directed IRA. When you're thinking about lending, the first thing I would suggest, and I do personally, is I don't draw up my own loans. I always get a lawyer to draw up my loans for a couple of reasons. First of all, even though I might think it's a good deal, now I've got somebody else who's looking at it from my perspective. Remember, the lawyer works for you, or she's there to protect your interests. And the other reason really for this is that every jurisdiction has its own, what I'll say are local laws or local rules around lending or any activity. And the lawyer will make sure that you're in compliance or that the loan is in compliance with whatever those issues may be. I'll use me as an example. Here on the East Coast in Maryland, all the states are squished together, right? Where I live, I'm within 50 miles of Pennsylvania, Virginia, DC, West Virginia, maybe even Delaware. Even though I'm in Maryland, if I lend to somebody who is in a different state, it's where the debtor resides. Those are the rules that prevail. So even though I'm in Maryland, if I'm lending to someone to Virginia, then I need to be compliant with Virginia law, whatever that is. Okay. I always start with a lawyer. And the other reason, quite frankly, I do that is that if there's a problem with the document, then I've got somebody to hang, right? I paid the lawyer. It becomes partially at least their problem. The other thing, at least for me, is I don't lend unsecured. So you'll hear two terms, either secured loans or unsecured loans. Unsecured means that if the loan goes south, you don't have anything to move or any collateral. Okay. You might have a personal guarantee, but quite frankly, at least to me, if the debtor has challenges, they probably don't have assets either. So the personal guarantee in and of itself really doesn't mean much. So I'm always looking for a security interest in a piece of property. What that means is that if there's a problem with the loan, then I have something that I can go after. Okay. I have a security interest in that. And again, I'm back to the lawyer. What part of that person's job is to what's called perfect the lien on the property. Okay. And again, every jurisdiction has a different way of handling this, and I want to make sure that it's done right. So when you're looking at that security interest or property, one of the things that comes up is you want to make sure that there's enough equity in the property to cover your loan. So you'll hear first position, second position, those sorts of things. And really what that means is if you're in second position, then there is somebody else who has a lien on the property ahead of you. Okay. If you're in first position, obviously you're the first one in line. But the thing that I find that a lot of people don't understand is that if you're in first or second position or third, if the person goes into foreclosure, that doesn't get split among you. Number one gets paid first, then number two, and then number three. So there's not a proration or a division among all the lien holders. That's why it's important to be first in line or understand at least where you are in the pecking order. The other term you'll hear is loan to value. So what that means is how much of the loan, what's the percentage of the loan to the value of the property? Okay. Personally, I don't lend money on anything where my loan to value is not at least 75% loan to value. A lot of times what I do is I work backwards. I always look at the worst case scenario. So if the person can't pay the loan, what are all the things that happen there? So first of all, I've got to get repaid. Okay. I'm going to pay somebody to do the legal work. So that's at least $10,000. There's foreclosure costs. And then I always put a cushion in there. So that usually gets me at about 75% loan to value, because I want to make sure that I can recoup all those costs and I'm made whole in the transaction. The other thing that you want to be aware of is if you're lending to somebody who is going to use the home or the property as their personal residence. Personally, I stay away from that. I don't want to lend to anybody who's going to own or occupy the property. And the reason for that is that you run into a lot of consumer loan issues, and every state has different rules about consumer loans and consumer protection and things that you have to do. And I don't want to get involved in all that. Some states allow you to have one or two, or again, it's a little bit all over the board, but I just want to steer clear of that. So I'm only lending on investment property. Okay. And if you have a lawyer involved in this, then they should be aware of those things. And I've had a couple of clients who basically pulled out of whatever arrangement that they were looking at because the lawyer involved advised them really not to lend to somebody who was going to own or occupy the property. I think one was in Florida. I can't remember where the other one was. Interest rates. I see them all over the board. You just have to be careful of two things. One is that you're not using a rate that's too high, and every state has usury laws, so that should be pretty easy to figure out what it is in the state that the debtor is in, not necessarily the state you're in. And the other is to have an interest rate that's too low, okay? Because you don't want the IRS, particularly if you're doing this in a self-directed account, to construe this to be a gift. And there's tax reasons for that too. So if you're doing it personally, a lot of times people ask me, how do I know if a rate is too low? And actually the government, the feds, the IRS puts out a publication every month, and they publish what are called the applicable federal rates. And it's a bulletin that's about, I don't know, 40 pages or so. But basically in that document, they list what the applicable federal rate of short-term, mid-term, and long-term loans would be. And they're pretty low, quite frankly. So you shouldn't really run into problems with it being construed a gift. But essentially, if the rate is below that for your type of loan, then the IRS could construe it to be a gift. If you're higher than that, then they're okay. So that's called the applicable federal rate. Up to this point, does anybody have any questions? I know I threw a lot out there, and I see a couple of seasoned lenders on the call. So if you guys have anything that you want to add to what I've said, feel free to chime in.
Tim asked in the chat, can you say or message the lawyer you use, or like, how do you find a lawyer?
The answer to the question is I've used a lot of different lawyers, and really I take a recommendation from somebody that I know in the jurisdiction that I'm lending in. Full disclosure, I've made loans to people in the DMV area, so that's a Washington, D.C. metro area. I've also lent to debtors in Michigan, Ohio, Florida, a couple other southern states, maybe Georgia, South Carolina. But personally, there are certain states that I don't lend in. Really what I'm looking at are the laws. How easy is it going to be to foreclose? At least in my mind, what I do is I always think, okay, and this is the CPA in me, right? What's the doomsday? What's the worst thing that can happen? Okay. And I work backwards from there. Some states, it's really hard to foreclose in. So I don't want to lend in those states because I don't want to tie my money up that long. But really what I would do is I would talk to your network, see who is in the area where the debtor is, because you want to make sure that you're compliant with whatever the laws are in that area. Anybody else?
So Tom asked, what if they move? And his second question is, securing it to the property, do you just get a promissory note and deed of trust?
I think if the debtor moves, I don't know that matters, because the promissory note is a promissory note. That's where the debt resides. Okay. I'm sorry, what was the other question?
He said, securing it to the property, do you just get a promissory note and deed of trust? And then he messaged again, speaking of foreclosure, can we sign a release of note instead of going foreclosure?
Different states have different ways of handling that. So there is a deed of trust that names the lien holder. Okay. Some states have what are called confessed judgments. I think Virginia is one of them. So sometimes the process is pretty streamlined. Other times it's not. I let the lawyer guide me on that.
Batista is asking, can you give a reasonable interest rate or range of rates?
That's always dangerous. First of all, I'm never too low. Okay. In my opinion, and this is just my opinion, to lend on an investment property at 4, 5, 6% even is being very generous. A bank, I was looking at buying a property locally here, and I want to say bank rates, I just did a quick scan, and I think on investment property, the lowest bank rates are in the high 6s or 7s. So I would never certainly be lower than that. It depends on the kind of loan, quite frankly. If it's something more like hard money, I'm probably close to 15. If it's what I would refer to as private money, maybe 9. Okay, but that's just me.
And then is there UBIT on loans that you borrowed in your self-directed IRA to buy a note?
Anytime that you borrow money, there's UBIT. Okay, so for those of you who don't know, UBIT stands for Unrelated Business Income Tax. And UBIT arises in retirement plans when a retirement plan either borrows money or is involved in what's called an operating activity. So you can think about like it's operating a business. Okay. So we'll just leave that one aside because we're not talking about that. But if my IRA borrows $75,000 to lend out and takes that money and lends out $100,000, so I take $25,000 out of my retirement account. I combine that with somebody who lent me, not with a personal guarantee of mine, okay, lent the IRA $75,000. So now I got $100,000 to lend out to somebody else. Then there would be UBIT involved. Okay. Anybody else?
If an interest rate, example 0%, is deemed a gift, is the lender or the borrower responsible for income tax?
If I lend money to somebody and the IRS comes back and says that's a gift, what the IRS is going to do is they're going to impute a quote unquote reasonable interest rate upon me. And then I will have to pay tax at whatever that rate is and probably argue with the IRS what is their rate right or wrong. So let's say for the sake of discussion that I lend money to Paul and I lend him $100,000 at one for 5 years. I'm sure that would be construed to be a gift. Quite honestly, it doesn't really do anything to Paul because he's the recipient of my goodwill. You're welcome. Okay. But for me, the IRS would probably come back and say, hey, that interest rate is too low. That's construed to be a gift. They might say that the true interest rate on a loan similarly situated is 8%. And then they would assess tax based on an 8% interest rate. Now, as a taxpayer, I've got 2 options. I could sit there and say, thank you very much, pay the tax and the penalty and run. Okay. Or I could go back to them and say, that's too high. Another interest rate should really be such and such a percent. At that point, it becomes a negotiation. So it's costing me time and money to hack out a rate. In my CPA practice, most times, first of all, I've only had this happen twice in my CPA practice. And both times it was in a situation where the person who lent the money passed away and then the IRS came in and they audited the whole thing. But basically, if it's me, I'm just settling at that point because I'm just spending time and money to hack out a difference of a 1% or whatever it is. Secondarily, what that does, although these days it's not as big an issue as it used to be, if it's construed to be a gift, then maybe I should have filed a gift tax return individually. Now you don't run into a taxable estate, at least in the federal side, unless you're somewhere north of 15 million. When I first started doing this 100 years ago, it was $1 million. So if I had to declare a gift and eat into what was called my unified credit, that was a big consideration. Now, 15 million, I'm not sure that it's such a big deal. But those are the considerations that you run into with a gift. In an IRA, I think probably what the government would do is say, if they construed my loan out of an IRA to be a gift, they would probably say I distributed it out to Paul, okay, to make the gift. So it becomes a prohibited transaction.
Last question from Nick. What are typical lengths of hard money loans? Is 6 to 9 months reasonable?
I'd say that's probably the norm. And there's a couple of hard money lenders on here, so they could opine in the chat if they want. I briefly mentioned this. I don't like to lend any longer than 5 years, but I might amortize a loan over a longer period of time and balloon it at the end of 5 years. 5 years term does not necessarily mean, at least for me, that I'm going to amortize it for 5 years as well. So I just want to make sure you guys get that. Let's talk about collateral a little bit. I'm very comfortable lending out of market. As I said before, I live in the Maryland, D.C. area. I'm comfortable lending in Florida and states where I'm not necessarily right around the corner. So one of the issues that comes up for me is the collateral. So what do I do, or what could you do to evaluate the collateral? One of the things that people will do is they'll review the history of the property. It's easy enough to find. You can go into the land records in whatever jurisdiction it is. And things that I find of interest are how many owners does a property had? Obviously, when was it built? What's the history of that property? What's the history of the area? Is it an area where it seems to be in decline, or is it growing? What are the stores that are around it? One of my colleagues has what he calls the Walmart test. If there's a Walmart within 10 miles of where the property is, he's pretty comfortable with that because he feels that Walmart, when they build a store, they have a certain demographic that they're looking at. So they're not going to build stores in declining areas, for instance. I look at what's going on in the area, how many property owners have there been. Sometimes you'll see a property that's been turned over a number of times. It very likely is in not as good a shape as a property that's only had one or two owners. Time frame comes into play here too. Was a house built in the 1970s or was it built in 2015? So you want to look at the condition of the property. I always pay to have a BPO on the property, a broker's opinion. It's just a soft evaluation of what a broker, a real estate person thinks the property is worth. And I always make sure that somebody that I know or that I trust has driven by the property and actually looked in the property. Because if you go out on Google, you can do this on where you live. If I look at Google Maps, Zillow is another good one, and I look at the picture that they have of my house does not look like that anymore. If you look at a current picture, for instance, and the grass is 2 feet tall, that tells you something about the property. I have one of my other buddies has a story about when he went and the property was on the outside, was meticulously kept up. Grass was cut. They had garden beds in the front. He went up and he looked in the window and the thing was stripped on the inside. There's no walls. It's just a shell. So you want to make sure that all the representations are true because, this is going to shock everybody on this call. People can be less than honest. You want to do your due diligence there and then evaluate your loan to value and those sorts of things. Any questions on that? Thoughts? Comments?
Moorhead said, is syndication using IRA funds plus other people contributing funds plus a bank loan to acquire income producing asset? Is that prohibited to the IRA fund without incurring UBIT?
Let's start at the beginning. First thing is IRA funds, right?
Yes.
Into a syndication, right? And then what was the next part of that?
Plus other people contributing funds.
Okay.
Plus a bank loan.
Okay. So anytime there's lending in there, or there's borrowing, I should say, by the retirement account or for the retirement account, UBIT is going to be an issue. In tax law, there's a body of rules, and I'm just going to refer to them as the indirect rules. And you'll see this in a lot of different things. But basically what those rules say is if I couldn't do something directly, or if I do something directly, the action is this. So if I buy something with borrowed money, there's UBIT. Merely by putting things and entities and other gobbledygook in the way, that doesn't change the essence of the transaction, which is that my IRA has borrowed money to make an investment. So if I invest in a syndication and the syndication borrows money, then UBIT could attach depending on how much the borrowing is. In the example, UBIT may come into play. And the reason I say may is because you have to look at the calculation and the other elements of UBIT.
Can I ask a related question to that? So I know you're mentioning it's about if the IRA borrows money, but what if you just loaned that money from your IRA to, say, the syndication to do the asset? Is UBIT involved then or no?
No, I think this is where people get hung up in this because we're using the word lend, okay, both as an asset and as a liability. So when the investment, when you're loaning as an investment out of the retirement account, okay, that's an investment. When there's an inflow, if you will, of money into the account vis-a-vis a loan, a debt instrument, then UBIT could arise. Anybody else?
And Randy asks, do you have a qualified person or contractor TOR prior to lending, or what contingencies do you add?
It depends on the situation. If I am lending hard money, for instance, then usually, depending on what the project is, I'll set up a loan schedule of sorts, meaning that I'll front some money. And then there's probably at least two gates or two things that need to be done, two phases, if you will, before I'll advance additional funds. I don't want to send all my funds out at once. And I didn't mention this before. The other thing that I look at too is who the debtor is. If it's somebody who's borrowed money from me before, we have history, my terms might be a little different from somebody that's new. So if we're into hard money lending, for instance, somebody who has a resume and he's done rehabs, maybe not as stringent with my terms as somebody that's on their third or fourth. Although having said that, there's a couple of guys out there that I know who rehabbing is obviously their business. They have crews. They might have 5, 6, 7 projects going on at the same time. One of the things that I want to be sure is that the money that's being lent on project number 5 is going into project number 5. I don't want it to be used on one of the other projects. So sometimes that's hard to guard against, which is one reason that I set my release of funds in phases. Anybody else?
Harvey asked, I think this is the last question for now. Can you loan money to a foreign entity secured by foreign property in a foreign currency?
Yes, maybe, yes. Okay. So the short answer is yes. With retirement plans, you can invest in assets anywhere, that they don't have to be US based. You can partner with, or you can deal with, let's say, and I'm using that term a little loosely, anybody. Okay. The only exceptions to that is you cannot invest in countries that are on the State Department's no-no list. So that would be countries like North Korea, Iraq, Iran, Sudan. The State Department puts out a list of countries that US citizens can't deal with, or you have to go through the government or go through heavy compliance to get there. So that's issue number one. And people who are associated with those countries, or there's certain entities or organizations. These tend to be people who might be on the, for instance, a terrorist watch list. But for everybody here, I don't think that's a problem. So generally, if you want to loan somebody overseas money and secure it by a piece of property overseas, generally that's not a problem.
Next question, do you then charge interest on the entire loan even before you've released the draws?
No, you can only charge interest on the unpaid debt is my understanding. So it's on the amount that's outstanding. Now, that said, I may have a prepayment penalty for terming out a loan. I'm making this up. So if I lent money for 9 months on a hard money loan, I might, if they pay it off early, there might be a prepayment penalty of pick a number or a percentage if they pay it off before the 9 months. The other thing I'll say too, any cost of funds that you incur in lending, I would wrap in to a loan origination fee or whatever you want to call it that the debtor has to pay. If you think about when you've borrowed money from Bank of America, you as the debtor, you pay for everything, right? Right down to the courier charge to get the loan documents back to Bank of America. So the debtor should fully expect to incur those costs for the pleasure of your money. So that's collateral. Let's just talk about what this looks like in a self-directed account. So, I've given you sort of some broad outlines or things that I look at. The negotiation is really between you and the debtor. We don't get involved in that, and we're not going to have a lot to say about the loan documents, with the exception of interest rate if it looks low. Okay. Every once in a while, we'll see loans that we know are not structured. They're not loans. It can't be open-ended. Okay, so there has to be a term. It has to be an interest rate. It has to be a lender. It has to be a debtor. Occasionally, I'll see a loan that won't have a term. Usually what we do is we'll push that back to the account holder and say, we're not sure this is right, and get them to do something with it. All of the terms and all of the inputs are basically at your discretion as the lender. Okay, so we're not getting in the middle of that. We're not saying that you have to do this or you have to do that or it has to be this or it has to be that. This is self-direction. All of that is up to you. So you negotiate with the debtor. A lot of times what our clients will do is they will call us first, our acquisitions team first, and they'll run the scenario broad brush by somebody in the office. And the reason we do that more than anything else, we want to make sure that you can do it. Nothing is worse than starting a process or saying that you're going to lend somebody money and then find out that you can't do it. So if a client called up and said, I want to lend money to my father in an IRA construct, a parent is what's called a disqualified person. So you can't do that. It's prohibited. At least with our clients, we want them to know that they can't do that up front rather than go through all the back and forth and you get to the point where you're about ready to pull the trigger and then find out that you can't do this. Okay. The other question that comes up a lot of times is when are funds going to be advanced? So this is a real estate transaction and it's going to settlement. You're going to be Bank of America, right? What'll happen is we have a process, you have the loan documents, you're going to send them to us. This sounds a little bit redundant, but we're going to send them out to you to read and approve. Okay, so you're going to sign off on the documents. And once you do that, then we'll advance money to settlement. If you're not going through a settlement company, because the settlement company, let me back up. The settlement company basically does all the paper shuffling. So it gets the debtor to sign the note, deals with all the rest of the real estate transaction. And then it's their responsibility to get the loan documents back to us signed. If you're not going through a settlement company or somebody that's bonded to do that, then you need to submit the signed loan documents to us first, and then we'll advance the money once we have those documents. And the reason that we do that more than anything else is until somebody signs a loan document, there's no obligation to repay. So we want to make sure those are in hand before we advance money out of your account. That's our process. Different providers have different processes. So any questions on that?
Paul asked, is there any problem selling a home in your IRA and then making a mortgage on the same home from your IRA?
No, no. In fact, that happens at least once a month, probably here. So what Paul's referring to is a seller finance loan. So if he owned a piece of property in his retirement account and he's going to sell it to somebody, many times it tends to be the person who's renting it. And basically now what he's going to do is he's going to be the bank on the deal. No problem with that. That happens all the time. So when you're originating a
Can I
loan,
ask just a quick question on that scenario?
Sure.
Now, if he's doing the seller financing, that could not be to a relative that's in your direct line, right?
All right. So there's a group of people that are referred to as disqualified persons. And these fall into three groups. The first is family members. The best way to describe this is if you reach out there and you put a dot in space, and that dot is you. If you draw a vertical line through that dot, anybody that's on that vertical line is disqualified. So your ascendants, descendants, spouses. That's parents, grandparents, great-grandparents, kids, grandkids on down the line. That does not include anybody who's on this horizontal plane. So brothers, sisters, aunts, uncles, they're fair game. It's just that ascendants, descendants. The second group is people who are fiduciaries to the account or work for the account. If you have an asset with us at MidAtlantic, I could not buy that asset from you because I'm too close. I work for the account. If you have an advisor who advises you on this account, then they're not going to be able to buy something out of your account. And the third group is referred to as certain other business relationships. And the best way to really describe this is by example. So if Dave and I are investors in an apartment complex, and Dave is a 10% investor and I'm an 8% investor, and it's a several $1,000,000 complex, we are not disqualified with respect to each other. We're just merely invested in the same thing. But if Dave owned 30% of that and I own 25% of it, now we are disqualified because between the two of us, we control the asset. We own more than 50%, so we could run the entity. We can set policy and those sorts of things. If I have a business and I have a partner and we're 50-50, that person and I are disqualified because we have a business relationship. Any of those disqualified persons are the only people that the IRA cannot transact business with. So anybody other than that is fair game.
I have one different question. You said owner take back. Is it a problem for seller take back on a property is going to be principal residence for the purchaser?
The only thing I would be careful of, and this is just me, is to make sure that you're not running into any consumer protection law issues. Every state has a different threshold with respect to lending, okay? And basically what I'm trying to stay clear of, if it's me, is having to register in the state as a consumer lending entity kind of thing. But that's just me. The other item that I want to briefly mention too deals with loan servicing. Personally, I do not service any of my own loans. I place them with loan servicers. And the reason I do that is that every state or every jurisdiction has a different way to handle delinquent loans. My day job is MidAtlantic. It's not watching my loan portfolio. So if I was self-servicing, I am very likely not to send out the notice on time, for instance, of late payment and those sorts of things. That's the servicer's job. And quite frankly, it's pretty inexpensive in the overall scheme of things. So if you're going to lend, I would consider loan servicing companies. And there's a number of them out there that do it on a national level, and they're pretty reasonably priced. So hard money loans, private lending, those types of loans, you deal directly with the debtor. get the terms all together, and that's a pretty straightforward vehicle. The last thing that I really want to talk about is, and we actually have a session coming up on this in a couple of months, maybe. There's a whole market for buying existing loans. And we have a number of clients that do buy existing loans. So maybe there was a note, the initial loan was for $100,000 at 5%, and the payment for a 10-year loan would be roughly $660. Okay. So after a couple of years, the unpaid balance on that is somewhere around 93,000 or so, give or take. Somebody puts that up for sale, I might buy that at maybe $70,000. So if I do that, my effective interest rate on that is about 9%. Okay, a little over 9%. So what happens here, the debtor is going to pay the $660 month in, month out until he or she pays off the loan. But at the point that I purchase the loan, and if there's a mortgage on it and there's an allonge and all of those, so it passes basically to me, and then I receive the payments from that point on. And if you think about this, sure, most of you on the call have gotten, at some point, you've gotten a letter in the mail that says, good news, you're no longer paying Bank of America, you're now paying Wells Fargo, and send your payments here. Basically what happened there is that Bank of America sold your loan to Wells Fargo. This kind of thing happens all the time. And it can be a good way to beef up your portfolio. Any thoughts about that? Anybody have any comments on that?
John Lambert said, I'm sure there are docs that any third-party loan servicing company would need to have in place with MidAtlantic for us to use for a private note.
Yeah. So basically there's an agreement, a servicing agreement that is between the IRA and the loan servicer. They generally need copies of the loan documents. So they want the promissory note, if it's been assigned, any assignments, and the mortgage documents and the allonges and those sorts of things. But basically, they take care of the payments. It's relatively cheap in the overall scheme of things. So is there another question?
Yeah, Bob has one question. Can we research and negotiate to acquire rental property that will be purchased 100% cash from an IRA without incurring UBIT?
And if there's no debt, there's no UBIT. So if the IRA acquires the property essentially for cash, well, there's no loan, then there's no UBIT. So let me just take a minute and run through, since we've had a lot of questions on UBIT, what the tax is and what it looks like. Okay, so we talked about how it arises. There's a loan where the IRA has borrowed money. So first of all, only IRAs are subject to UBIT. So if you have a solo 401k account, for instance, those accounts are not subject to UBIT. And there's a whole story behind that, which I won't bore you with at the moment. But basically, we're looking at IRAs, which are IRAs, Roth IRAs, SEPs, and Simples, inherited IRAs. Okay. So let's say I have a rental property, since we're talking about rentals there. And I borrow money to buy the property. My loan to value on the property is 75%. So I bought a property at $100,000. I borrowed 75. I put 25,000 of IRA money. So my percentage there, my borrowing, the amount of borrowing or percentage of borrowing is 75%. I think everybody understands that. From there, what I'm going to do is compute the net rental income on the property. So I rent out the property and maybe I got 18,000 in gross rents. I deduct my normal rental expenses, just like I'm doing this on my individual tax returns. Insurance, interest on the loan, real estate taxes, supplies. If I have a management company, the management fees, utilities, if I pay utilities, whatever those rental expenses are, including depreciation on the property. Let's just say for the sake of discussion that my hard expenses are $8,000. And then I've got $3,000 in depreciation. So my cash flow is 10,000, right? 18 less 8 is $10,000 of cash flow. My net rental income is the $10,000 less another $3,000 of depreciation, which is $7,000. So if this was a personal return, I'd pay tax on $7,000. Everybody got that so far? So to that, I'm going to apply that debt ratio, which is 75%. So 75%, I knew I was going to screw myself here. Somebody can do the math for me real fast. I turn my math brain off at 5 o'clock. So 75% of $7,000 is what? Roughly $5,000, give or take. Okay. That's the taxable income for UBIT purposes. Okay. So stated another way, 5,000 of the 7,000 of net rental income was derived from borrowed money. Okay. The other 2,000 came from my $25,000 that was in my retirement account. So the theory here is whatever is earned on the retirement plan money is always tax deferred or tax free if it's Roth. Okay. It's only the income derived from the borrowed money that's taxable. So in that calculation, $5,000 is subject to UBIT. In the UBIT calculation, there's a $1,000 exemption, so you're at $4,000, maybe $1,500. Maybe the tax is $1,500, and I'm sure that's high. So if you're thinking about this, does this make sense to do or not? If the tax was $1,500, which again I think is high, if I had cash flow of 10, less the $1,500 takes me down to $8,500 of cash on cash return. Everybody with that? So on my $25,000, if I returned $8,500 a year, is that a good deal or not? And you have to make that decision. So that's in a nutshell how you think about, is UBIT worth it or not? My point to this more than anything else is really think of UBIT as just being another expense to your investment, whatever that is. And then you have to decide whether that's a good use of funds or not. I have a client, for instance, who recently, he bought a piece of property in his retirement account, and he went out and borrowed money independently. Okay. He bought the property for $85,000 and he borrowed $80,000. Now, in his case, the UBIT is going to be relatively high because it's like what, 90+%. It's almost 100%. But first of all, it's on the net income, right? He's only out $5,000. That's the only retirement plan money he used. So even if he earns just $2,500 on that $5,000, that's a 50% return on the $5,000 of retirement plan money. Is that a good deal or a bad deal? And again, that's your call. Everybody's got a different threshold. One person's floor is another person's ceiling. Don't necessarily be afraid of UBIT.
But borrowing has to be non-recourse to the IRA. Are there lenders who will loan non-recourse? Of course, they are secured, but still, question mark.
When the retirement plan is borrowing money, it has to be non-recourse. So in the old days, we used to call that a commercial loan. And basically what that means is that the lender can only look to the collateral for repayment. Now, it could be, we have situations where somebody has collateralized 2 properties in their retirement account for one loan. There could be some sort of umbrella financing there. There's a lot of different ways to do that, but the account holder, beneficial owner of the account, or any disqualified person cannot guarantee the loan. So another scenario that we see a lot is, let's say for the sake of discussion, that me and Harvey and Tito are going to form a little LLC. We're going to buy a piece of property. Harvey's going to use retirement plan money. Tito and I are putting in personal money. We're going to borrow money. So Harvey cannot personally guarantee the funds because he's using retirement plan money. I can personally guarantee because I'm not using retirement plan money, and Tito can personally guarantee because he's not. So instead of being a third, we might say that because we're taking on the personal guarantee component of this, maybe Tito and I are a higher percentage than Harvey. Okay, and we can negotiate that up front because we're not disqualified. So we see a lot of situations like that. You can work with this a lot of different ways, but really what you find is you have to do this all up front. So this is not when you're thinking about these investments, especially with UBIT, it's really not a last minute back of the napkin art of the deal kind of thing, right? You got to get this stuff up front. But we see a lot of creativity along those lines as well. This has gone in a different direction than I thought it was going to go. It's not necessarily bad. You have a lot of different options here, a lot of possibilities. Lending, as I said in the beginning, it is our second, at least here, it's the second biggest asset class. People who are real estate investors are pretty comfortable lending as well. Another thing that we see a lot of times is particularly rehabbers and those sorts of things. We'll see a rehabber number one lend to rehabber number two, short-term funds, very short-term funds, to allow rehabber number two to finish a deal. And a lot of times these guys, they start breaking down walls, opening up things, and they find other problems, okay, or there's delays for whatever reason. And they might need $25,000, $35,000 to get through. It's a short-term opportunity to put a little extra money into play. Hopefully, if you liked what you heard, please let us know. If you have thoughts or comments or questions afterwards, so if you're like me, 2 o'clock in the morning, you wake up, have a question, don't call, write it down, okay? Although Siobhan's on the West Coast, she might still be awake. You can call her, don't call me. But certainly send them on to us. We'll get them answered as best we can. For those of you who are clients, we have changed our online access. We've upgraded it. Check that out. Log in. If you have any troubles, don't hesitate to call our office. If you haven't done it already, you have to sign up and a new password and those sorts of things. But I think you'll find the accessibility and the tools there much better than they were. Everybody, at least that I've talked to, is very happy with the changes that we've made. What's our topic next month, Siobhan?
The end of next month, we are talking about what you can and cannot do within a self-directed IRA.
Oh, so our prohibited transactions. That'll be a good discussion. So if you have any questions, don't hesitate to let us know. Good to see everybody. Have a great night and talk to you soon.